Welcome back, YouTube. We're going to this morning go through a house that I bought on the specific numbers, the fix-up. I'll show you the picture of the house and the ratios of rent and percent return. I'm going to look at this, and the percent return is what's called the cap rate. Technical terms, the cap rate is the revenue that you have in the property minus expenses. So for commercial property, it's minus taxes and insurance, but a lot of times I just figure it before expenses because it gives me a comparison to existing properties and those type of things. Makes the numbers easier. But I'll show you what that is and what the fix-up costs and things on the house. So first I'm going to show you a picture of the house. So let's switch over to the other screen. So this is the house. It's in Missouri. And it went on the market for a price which was good for the area. And what I generally do when I'm buying houses is I'm looking for a price on the house that is good for the area to start. I don't go out and find a house listed and market and then give them a ridiculous offer. And so if you look through this house, you kind of at the start you can see it might need flooring depending on how bad it is. The house looked a lot worse than this when we got inside. It does have some nice countertops there, as you can see. Nice house. It was beat up quite a bit. You see the problem here: the refrigerator doesn't fit under the cabinet. And so you think maybe you need a smaller refrigerator. We actually just took a cabinet out here. Instead, it was about $50 instead of $1,000. So this is the house, when we took it over, and it was a lot worse than these pictures. These must be from the last time they moved in. And it does have good bones. You see the front of the house. You'll see that back here. We get back to the beginning. It looks pretty good. It just needs to be cleaned up some. And so let's go through the numbers on this house. Here's the numbers. Sale price was $210, and what happened on this house was I put an offer in for the exact asking price. They got an offer that was much higher because the market's still pretty hot, and that offer fell through. They said they had a roof inspection and they had some problem with that, and they had a plumbing inspection and had some problem with that. And those roof and plumbing problems are something we deal with all the time in our company. And if you have a roof problem, a lot of times it's going to cost you maybe $15,000 to replace the roof, and me a few $100s to fix it. Or plumbing's a similar thing. And so people just don't have good processes built up and understanding of how to fix these problems for cheaply. And so I put an offer back in, worked with a good real estate agent, convinced them it was a good offer, and they took the offer the second time. So we had a $210 purchase price. $2,000 was the deposit. Credit on the taxes. This is the amount of taxes so far during the year up to the point that we bought it that the seller would have paid, so we get a credit for that at closing. And then down here are fees for the recording of the title, settlement fees, CPO, recording fees. Up here there's actually a financing. I took an existing property and financed it for this much at 7 1/4. Here are the fees on the refinance work. Total fees were $1,436. Appraisal $225. The bank was doing an in-house appraisal, which is maybe $400 cheaper than a regular appraisal. It means that they sent somebody with the company and he estimates the value. You can do that once you get into rentals far enough that the bank is more looking at you and says he's running the business. You come down on the fix-up. We got lots of bids on this one to kind of speed up the process and make it better. Flooring was $27.17. Now I think we could have done the flooring a little bit cheaper, maybe $2,000, but we did it with the existing company we've done before, and so we could do the flooring a day after the closing and actually measure before the closing. So that probably saved us like a week of time on the fix-up, and that week to me is worth around $350, $400 in and of itself. So I went ahead and did that, although on the next one we'll probably take the time to find a better, cheaper way to do the flooring. Fix-ups. The fix-ups went pretty much as planned, except that one place they ran into electrical issues, so we had to separately do the electrical fix and then get the fan put up. We do ceiling fans in all the rooms, make sure the blinds look good. If it's new blinds, we do 2-inch blinds because they last forever. Painting was $4,200. We painted everything inside the house and the cabinets, which this is a great price on that painting. I paid Jackie to manage the project from start to finish, all the bidding and those type things. Electrical work, plumbing work, just there was some problems with the toilet was running and some things like that. And the way I found those problems is Jackie had already found them, but when the water bill came in, it was like $175, and so I knew there was a problem with water, and so we investigated to make sure we had that fixed. Appliances were $1,313 on the house. I think we had to get a stove and refrigerator, and so that was $1,313, this was reasonable. We investigated Home Depot, Lowe's, and other appliance places. We don't have good non-normal appliance places in the Missouri area yet, so if you know of anything, you can let us know. But so I think we did Home Depot or Lowe's, and they were able to deliver those out for us. Mowing, somebody mowed 3 times as we were doing the fix-up. We want to make sure the house looks nice. So people drive by, they like what we're doing. They'll tell people the house is getting fixed up. A lot of times, half the houses we've had have been rented before we haven't finished the fix-up because what we do makes it look nice. Cleaning the house, $150. I think we found a cleaner through the painter. A lot of times if you get the right level of person that works on rentals, you can ask them for references for other people, and they'll know other people that do similar jobs at similar cost structures. Garage door, we didn't do a big fix, we just fixed it a little bit. We probably need to replace it at some point, but we didn't up front. Now, you think that the problem with fixing things is the cost, and sometimes it can be the cost, but it also can be just that you don't want to spend the time, maybe the 2 weeks, to not have the house rented, and so you do a quick fix so that the time frame can be faster. So this is our total fix-up cost. Let's see, $10,868. So I did a little formula here, and so ignoring taxes and expenses, I just ran a ratio, and before fix-up, with rent of 12 months at $1,600, which is rent at $1,600, we're looking at 9.14% return. You add in the fix-up costs, I put $11,000 in there, and you're looking at 8.69% return. Just the ratio of rent to the cost. Now in Lee Summit, Missouri, the percent is slightly higher than it is in Arkansas because the taxes are a little higher and the growth potential is not as much as in Northwest Arkansas. And so these are pretty good ratios. Comparing that to the 7.25 that we had on a rate on a property, and we're looking at about break even for now. We also freed up some cash when we actually bought this property, and so that cash, the reason we did that is because right now, coming up in 2024, there's some interest rate things we're going to hit, and so we're trying to make sure we have plenty of cash for those interest rate risks that are occurring. And so that's the numbers on this house. Again, it's in it's in Missouri, $1,600 a month. Initial purchase price was $210. Hope this gives you an idea of how you do it. I know some people that have watched the videos have said, hey, this is not the way you do rental houses. But in fact, when you can go into a place and you can buy a house for $210 that might easily sell for $250 once fixed up, you have quite a bit of a buffer in there as far as risk on that investment. So if you compare this to, for say, Home Depot stock, and let's say Home Depot stock on the market is selling for $300 a share, and I buy it at $300 a share, I'm buying that stock at market value. When I buy this house at $210, I'm not buying at market value. Market value in this house is probably about let's say $240 to $250 range. And so I have a buffer in there, and that buffer gives me, one, a reason to do it. Secondly, let's say that the sales business I have, or my job ends up having free capital like it does, because I'm pretty cheap, we don't spend that much. But if it does, then I can put that free capital to work at 7.25%, paying down this loan. I lose access to that money, so right now I'm not doing that due to interest rate risk. But if interest rate risks start turning around, and so that new things and existing, house loans, when they come up for due after 5 years, if they do, then you can, if we don't have that risk, then you can pay this down, and then you're getting a guaranteed 7.25% on that cash that you have, which compared to everyone else's, 4 or 5% is a really good return on that. So I now have that as an opportunity. And so there's about 3 or 4 different reasons that I would do this particular deal. If the house was priced at, we'll say $240, I wouldn't do it. So just removing one reason would be enough for me to not do this deal. But it's already in an area that we know how to manage properties in. We have people in place to do the work on the house, and so those things are very known, and so that makes it a very low risk investment for me. So low risk investment, getting paid, probably $20,000-$30,000 to do it, having the potential of paying down loans at 7.25%, even now, and having a return on the house of 9 or 14%. Not 9.14 or 8.69, depending on how you look at it. Those are reasons that I did this house. So if I add this to an existing portfolio, it's an asset, and it has some benefits there. And so I've done this, and I have another house I have under contract in that area also. The difference in the other house is that the rent is not $1,600 a month, the rent is $1,800 a month. So the $1,800 a month rent on that house, I can just run the numbers for you real quick. If we just take these two and we just change the number to, we'll say, 1,800 on both of these, you can see my percents get higher. So in that house, I have it under contract for $240. So at $240 on that house, these are the numbers that we're looking at on that new house. So it's a very similar deal to this as far as percentages, as far as the amount that we're buying the house for versus what it's worth, and the area we have is a similar situation. So just wanted to show you the deal, give you a real life situation. Over time, you will gain money from several sources. Number one, you will see the price of the house go up, and that can be from appreciation in the area. It can also be from inflation, because over time this house will hold its value as the value of the money goes down. And so really, this right here, if you do, let's say, a 5% inflation, and you take that times what's borrowed, my interest is already covered by the house, and I'm making $12,000 a year on inflation. This is actually one of the main ways that you gain money in real estate, is by the money that you've borrowed is going down in value as you pay it back. And so if you look at this $240 and the 7.25 is covered by the house, then I've got 5% interest, 5% inflation, and so I'm really gaining $12,000 next year on this house based on inflation. So you got the $12,000 next year, and about, we're going to say, decreasing, but first year, and you've got the, we'll say, $25,000 difference between the value and the price of the house. And then you have, let's say, we make $1,000 profit on the rent, and so first year you're probably making $38,000 on this house. Second year, let's say you still have a similar inflation number but a little bit less. You've got 0 here because the house doesn't really change in value. Maybe it will go up in value a little bit, so you add a couple thousand there. And then on this number, your principal amount goes down some, and so maybe you're making $2,000. And so the first 2 years, really in this house you might make $53,000. If you extend this out, and we'll just keep it flat for 5 years, then when I look at going to this house, the way I look at this is I say, okay, this is what I'm going to make over 5 years, $98,000. How does that look like from an investment standpoint, considering that the amount I invested was negative $20,000? So hope this gives you an idea of how real estate can work. There are better deals, there are worse deals, there are better times to take risks. The things I would encourage you to not do are don't take risks beyond what you can afford to lose. Don't just shift money from one asset to another one because you think it's popular. Always have a reason or a moat in that investment, a reason why it's worth more to you than to somebody else. And make the decision slow. Just don't make a bunch of decisions and just move things around. People don't stay consistent in what they do, and stay consistent over time. If you get a game plan that works, then keep following that through, year over year, reviewing your results to see what might be wrong about your process and how you can improve it. But if something works for you, do it, and don't worry about what other people are saying. People might say, hey, this is a bad deal, this is a bad deal. Well, my question to them would be, well, what results are you getting over the last 12 years? And if theirs are 10x what I'm getting, then great, I'm in. Let's go, let's figure out what you're doing and do that instead. But most of the time it's just people complaining. So hope this helps you. Have a great day. Like and subscribe down below if you want to see the next one. Leave me a comment. Let me know if you want to see another house or the next one that I do. You want to know more about fix-ups, after pictures, anything like that. And I'll talk to you later. Bye.